Good afternoon, and thank you for joining us today. I'm Bruce Tatters, CEO at Red Cloud Securities. Today's webinar features Seabridge Gold, the premier gold and copper exploration development company that we follow in the capital markets today. All of its projects are domiciled in politically secure regions of Canada and the US, and Seabridge ranks #1 in gold reserves per share and gold resources per share among all North American listed gold companies. This leverage to gold is particularly well demonstrated by the outperformance year to date of many of its senior and mid-cap peers. Also, in addition, I'm certain that Rudi will present on Seabridge's very large copper reserves. We're extremely privileged to have Rudi Fronk, the co-founder, chairman, and CEO here to provide a general update and outlook for the company. In addition, we're also glad to have Jim Anthony, Seabridge co-founder and well-known macroeconomic commentator, with us today to provide both an outlook on the gold market and an update to investors today on the dramatic macro events unfolding in real time before our eyes. On our last webinar, Jim correctly highlighted that the gold market rally was primarily an Asian phenomenon and that at some point the West would be joining the party. We've seen the beginning of that now, and I'm, for one, very interested to see Jim's thoughts on how things are going to pan out as we head into the end of 2024 and into 2025. As always, we'll begin with some of Jim's comments prior to Rudi beginning his discussion on Seabridge. After a formal presentation, we'll be taking questions live. Please send us your questions via chat, and we'll get to as many as we can possibly. You can type your questions in the chat box at any time. To start, we'll handle some disclosures and then get right into it. For Seabridge Gold, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of their corporate presentation. For Red Cloud Securities, I'd highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or recommendation. As we note, this call does not take into account particular needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research located on our website regarding Seabridge Gold for specific disclosures. So now I'm going to turn it over to Jim and Rudi to begin.
Thanks, Bruce. So next slide after forward-looking statements, and we'll get into it. Right now, we can clearly see that there are two gold markets on this planet, one in the West and one in the East. The West is driven by monetary policy. It's basically all Fed all the time. Gold is a passive, really a dead asset. Thank you, Berkshire Hathaway, for that. Gold earns no interest, so gold falls and when real rates rise. It's always been that way, hasn't it? Bonds are better than gold when rates fall because the bond price rises. Deficits are good for stocks because it's more liquidity. Debt levels are manageable. Jay Powell says so. They're a non-issue, and actually they were a non-issue back when we had zero interest rate policy. Not so now. The exceptional U.S. economy will always attract capital. Well, it better because it doesn't have any of its own anymore. And the Fed is cutting rates to avoid a hard landing, which seems odd in an economy that's growing at about 2.5% a year. So that's how the West sees things, and that's not an incentive to buy gold stocks. And of course, gold stocks are a Western phenomenon. So we, in fact, have gold stocks trading for less than half of what they were trading for in 2011, when on a monthly closing basis, gold is now $700 an ounce higher. So not a good market for gold stock. Now looking to the East, it's all about fiscal policy and fiscal risk. First of all, gold is an active asset that cycles just like the dollar, especially in the oil market and natural gas now as well. Gold does not depreciate like the dollar. Gold is no one's liability, can't be sanctioned. Deficits are inflationary. Everybody knows it. Debt is destabilizing. Capital is probably in the process of starting to leave the US due to a negative investment process whereby they, that is, Americans own put it the other way around. Foreigners own $22.5 trillion worth of US assets, more than US investors own of the rest of the world, which is making US highly vulnerable. And the Fed is cutting rates due to fiscal pressures. That seems to be clear to everyone outside the United States, at least. Next slide. So let's look at the fiscal situation. US federal government spending is on the rise again. This chart is in real constant dollars. So we had, of course, the spikes in spending, which were due to the pandemic, and now it's on the rise again for really no good reason. Next slide. And as a result, deficits are also rising, despite a growing economy and very low unemployment by historic standards. This shouldn't be happening. Next slide, please. And the result of that is that federal interest expense is now 33% of annual tax receipts and rising rapidly. There are about $15.5 trillion worth of US federal debt that will roll over the next 3 years. The average interest rate for that debt is 2.3% currently. It's not going to be 2.3% when it rolls. It's going to be higher. So this number is going to continue to rise. Next slide. This is how foreign investor looks at the dollar. They look at it versus gold. Americans tend to think in terms of the Dixie, the relationship between the dollar and the euro, the yuan, and the yen. But that doesn't work when you're outside the United States. This is what foreign investors are looking at, and the result is they want more gold. Next slide. Foreign investors are avoiding US sovereign debt. If you look at total foreign holdings of the T-bills, they've gone from just under 50% to just over 20%. If you look at coupon stuff, duration, it's gone from over 60% to just a little over 30%. So foreign investors are backing away from US sovereign debt. That's going to be a big problem coming up. Next slide. And another reason for doing that is that there's a risk of sanctions. And you can see, first of all, on the left, a list of the countries that are currently subject to sanctions. And on the right, a graph that shows you the increase in those sanctions on a GDP-weighted basis. There are lots of people now, and countries and companies subject to sanctions, which is another reason not to be holding a lot of dollars. Next slide, please. And so one result of that is that central banks are increasing their holdings of gold. They are rising as a percentage of total reserves. That's the red line, whereas holdings in US treasuries are falling. That's the black line. And they're going to meet here at some point. Next slide, please. So the World Gold Council went out and surveyed the central banks, the emerging market central banks in particular, that have been buying gold, and they gave their reasons for why they're doing it: selling dollars, buying gold. And the reasons in order were to hedge the dollar in terms of inflation, then to hedge default risk. Believe it or not, nobody in the US talks about it. People outside the US do, and to avoid sanctions. Understandable. Next slide, please. So The result net is that physical gold is increasingly headed to Asia. The Swiss have the 4 largest gold refiners on the planet, and where they are sending gold is an important tell, and increasingly it's going to India, China, the Gulf Coast. These are the places where gold is attracting a premium and is moving toward, not so much to the West. Next slide. So we look at the West. Western institutions have almost no exposure to gold. And this, more than any other reason, is why gold stocks have been struggling. And in fact, 71% of asset advisors have essentially no exposure to gold, which is a big number that has not been getting much better yet. Next slide. Here's a fun one. This is from McClellan, very well-known, long-standing advisor to stocks and asset managers. They see deficits as bullish for stocks, and in fact, the figures do not lie. So when you talk to Western investors about the fact that deficits may be a problem, what they see is a higher S&P, more liquidity, so not concerned. Next slide, please. And here we go into rate cutting. There were actually 26 rate cuts in September alone. Amazing turn of events. We're almost at historic levels. This, of course, is good for bonds, and bond buying proves it. Of course, once the rates get low enough, then it'll be an incentive to buy gold, but not yet. So next slide, please. So here's an interesting slide. Apparently, the quarter we just left was the 4th best quarter for buying bonds this century. And if you look at Bloomberg, who have an index on everything, they have an index on the 60-40. That is the prevalence of people investing or managing their portfolios to be 60% assets and 40% bonds. And it's never been more popular. So the amount of money that has crowded into bonds over the last year has been extraordinary, all mostly the last 3 or 4 months in anticipation of Fed rate cuts. Next slide. And here's where we see the selling. In fact, we've seen significant net selling by Western investors through physical gold ETFs, which reached a peak of over 3,000 metric tons in 2020, and then started an abrupt turn down, and along with the gold price, which is the exact relationship you would expect normally to see, which was an anticipation of real interest rates rising. That is, the Fed raising rates. And that continued with wild abandon, selling something like 1,600 metric tons, a huge amount of gold, until Ukraine. And that was the final straw for foreign central banks, particularly emerging market ones. And the game was on, and additional amount of gold made available by Western investors through ETFs was more than taken up by central banks and private investors in China, India, and elsewhere. Okay. Oh, and by the way, you can see at the bottom of that black line, the ETF gold holdings, that there's a little turn upward. And yes, there is a turn upward. We've stopped seeing the wholesale selling of gold from the ETFs. And in fact, they have net added $3 billion worth of gold purchases in August. but that's a tiny amount compared to what was sold. There is still not a lot of new money coming into the gold market from the West. Next slide. Here's a fun slide. Every one of those blue vertical lines is another $1 trillion in US debt. And you can see they come thick and fast once we get into the pandemic and the response to it. And not surprisingly, as you get more blue lines, you get more lift in the gold price, which appears in the red line above. Now we're seeing an additional $1 trillion of debt approximately every 100 days. This is not sustainable. Next slide. And this is probably the most scary graph of today's presentation. We now have a US economy that relies entirely on foreign net savings. US is right across the board a net dissaver. In other words, is not able to generate its own capital at all. It is dependent on foreign capital. And that's particularly relevant now when both political parties, and who knows who's going to win, and I'm not going to get into that, but both parties are substantially in favor of reshoring manufacturing, which will take an enormous amount of capital because the US can't even rebuild its military anymore without beginning to attract more manufacturing capability onshore. And this is occurring, this need for reshoring capital, when it appears that foreign capital is beginning to leave the US. How do we know this? Well, little things like the Chinese massive reliquefaction of their economy last week. What happened? Well, you should have seen a collapse in the yuan. It went up. Why? Because Chinese capital was being taken out of the US and back repatriated to China. So, and we're also seeing somewhat similar moves, smaller scale, from Japan. So where is the capital going to come from? Well, probably the Fed. There's really no other source. As you can have seen in the presentation to date, just not getting the foreign interest in investing in the US that we've been used to. Next slide, please. And liquidity is extremely loose. You couldn't have it be much looser. This is the Fed's own data. What's interesting here is that every time the financial conditions are not loose, every time they tighten, you get a recession. The US cannot afford a recession. Currently, the US is running a deficit of about 7.5% of GDP. If we have a recession in the US, we're going to see that number increase to 11, 12, 13%. It's very easy to project. So those conditions are going to have to remain. And that's another reason why you probably get better GDP for performance in the US than elsewhere. But you're also going to see increasing evidence again of inflation. Inflation has not been cured if you have this kind of extremely loose financial conditions. Next slide. So US federal debt to GDP is out of control. It's over 120%. You know, this was okay. It was manageable with zero interest rates, but not so much when the interest rates are real and currently still above 4.5%. So the debt has to be inflated away. And it's not as if the US is naive or innocent of knowing how to deal with this, because next slide, please. This is what was done after World War II when US real rates fell to minus 14%. on a lower debt to GDP ratio than we have now. But that's going to be necessary to reduce the debt to GDP ratio. And as you can see on the right, one of the main methods was yield curve control, where the Fed simply pinned the 10-year yield at 2.5%. So as we move into this kind of reality where the fiscal becomes more important than the monetary, and the debt and fiscal policy related to it become more important than interest rates, we're going to see the West invade the gold market like there's no tomorrow, because in many respects, for the dollar at least, there may not be. And as a result, we will get the next move in the gold price, I'm predicting, to take us well past 3,000. The East is not going to stop buying because they understand already what's happening, but the West will join. Thank you. Back to you, Rudi.
Thanks, Jim. Sounds like I need to go get more exposure to gold.
I thought you had some.
Yeah, only 95% of my net worth.
Yeah, I think that was the number I remember, yeah.
So thanks, Jim. Great presentation like usual, and hopefully these slides will be available to people to look at later, Bruce. I'm sure you can arrange that. So what I'd like to do on the Seabridge portion of this presentation is not go through the typical slide deck, but concentrate more in terms of some of the recent developments that we've had within the company. And just as a reminder, just to point you to where our assets sit. So we have 5 assets in the company we consider material. We have KSM in British Columbia and Courageous Lake. Those are 2 advanced stage assets with reserves. And we have 3 earlier stage assets, Iskut, 3 Aces, and Snowstorm in Nevada. So when I look back over the course of this year, these are what I point to as the 5 most important developments of the company. Number 1, since December 31st, as a result of activities on our projects, we added over 12.2 million ounces of gold and 4 billion pounds of copper into our mineral resource inventory. Second, we completed a pre-feasibility study on our Courageous Lake asset, showing a project capable of producing over 200,000 ounces of gold a year for almost 30 years. Third, and this is probably the most important one, we were able to achieve the substantially started designation at KSM, which ensures that the environmental approvals we hold are valid for the life of the project. Fourth, just recently, we were granted a 20-year renewal of our license of occupation for KSM's Mitchell Treaty Tunnel Complex. This is an important component of KSM that ties the mine side to the mill side. And then last but not least, yesterday we announced some significant mineralization that we encountered at our Iskut property in the Snip North area, zones that are very wide with both gold and copper. Why is ounce count important? Well, one of the guiding principles that Jim and I set for the company when we formed Seabridge in October of 1999, and by the way, Jim, happy anniversary. This month marks the 25th anniversary from when we launched Seabridge. Hard to believe it's been that long. But one of our guiding principles was the idea of trying to offset equity dilution with ounces, simply growing ounces in the ground faster than shares outstanding. So I mentioned that over the course of the last period of time, we've added 12.2 million ounces of gold. That was in the face of issuing about 4 million shares over that time period. So we added about 3 ounces of gold per common share. If you look at where we were at the end of 2023, we were at about 2 ounces of gold per common share. So the ounce additions over the past few months have definitely offset the dilution once again. And that's something we strive to do year in and year out for our shareholders. And why do we do that? Well, we think that drives shareholder value. If you look at when we formed the company, our intent was to create what we thought would be the industry's best leverage play to a rising gold price. And we do that by growing ounces of gold in the ground on a per share basis. And as you can see over the long haul here, we've delivered on that, with our share price up over 8,000% during this time period, during a time period when the price of gold was up over 800%, or about 800%. What's always interesting when I look at this chart is how poor our industry does relative to the gold price. When you buy a gold mining stock as an investor, the expectation is if the gold price is up 10%, the price of that share you just bought should be up by more than 10% because of the operating leverage that most gold companies have. In fact, if you look at our industry, they have significantly underperformed the gold price in a meaningful way. And we point to the per share metrics as the reason why that is the case. Most of our industry continues to dilute their shareholders without offsetting that dilution with value. Here's just looking at the 4 largest gold companies, publicly traded companies in North America: Barrick, Newmont, Kinross, and Agnico Eagle. You can see here their share counts in 2007 versus today, and their ounce counts and production counts. They have destroyed per share metrics. And I'm just going to pick on Barrick here because Barrick is probably the worst performer of a gold company over the past 25 years in terms of share price performance. With gold up over about 800%, their share price is only up about 30%. Let's look at the numbers. So Barrick has more than doubled their share count since 2007, since the financial crisis, yet their production is down 50%. They produce half the amount of gold today as they did in 2007, with more than twice the share count. Their reserves have gone from 125 million ounces down to 77 million ounces, a big drop in reserves. And when you tie this back to per share metrics, they have destroyed value on a per share basis. You can say the same thing for Newmont, the same thing for Kinross. The one company, in our view, that stands out is Agnico Eagle. They seem to get the per share concept. Yes, they've increased their share count dramatically over the past several years as a result of what I consider some very accretive and well-timed acquisitions. You look at their production growth over the same time period, second to none. And they've also been able to maintain a relatively flat reserves per share. And that's why when you look at these 4 companies over the long haul, why Agnico Eagle has outperformed these other companies in a meaningful way. Jim mentioned the idea where do gold stocks stand today on a historic basis. I've been in the business for over 40 years running publicly traded gold companies. I've never seen a bigger disconnect between gold equities and the gold price. As you can see here on this chart of the GDX to GLD, gold stocks today are trading at less than half of where they should be on a historic basis. So I agree with you, Jim, that when the Western investor shows back up, and they're the ones that buy stocks, the East does not buy stocks, they buy physical gold. The West is the ones that buy stocks. When they come back to the table, we're going to see a move in gold mining equities that's going to please those of us that have a lot of our net worth in those equities. Turning now to one of the developments I mentioned, Courageous Lake. People forget that we actually have Courageous Lake. All of the focus at Seabridge over the years is KSM. Courageous Lake is an interesting project in its own right in terms of size and location. So Courageous Lake is an asset that we acquired from Newmont and Total in 2002. We did some work on it, increasing the resources pretty substantially over time. In 2012, we did a pre-feasibility study that at that time showed a fairly marginal project. We then sat on this project for a number of years and only came back to this project a few years ago as the gold price really started to move. And at that time, we did an updated pre-feas to show what this project could look like redesigned. We shrunk the size of the throughput, going down to about 7,500 tons per day, which is higher than before that. We shrunk the size of the open pit, and it made a more concise operation. And if you look at the updated pre-feas, we can now show an initial mine life of just over 12 years, averaging over 200,000 ounces of gold production per year at an all-in cost of production of about $1,000 an ounce. The industry average today for all-in sustaining costs of gold production is about $1,500 an ounce. So here's a project that can produce gold at $500 less than the industry average. And then on top of that, if you actually mine deeper below the permafrost, you could add another 16 years of mine life on top of that, still producing over 200,000 ounces of gold a year. I think it's fair to say that in our market cap today, Courageous Lake does not give our shareholders a lot of value. We want to find ways to get value to our shareholders for this important asset, and we're doing so. We hired a banker group to kind of look at ways to unlock value here. We are discussing potential sale of this asset, joint ventures, or other opportunities that we see to advance this asset to try and get value on this. So stay tuned. Turn now to KSM, which is obviously the asset that most people connect with Seabridge when they think about Seabridge. So KSM, it's hard to believe where this asset has gone from the time we acquired this asset in June of 2001 from Placer Dome. It's now grown to be the largest undeveloped gold and copper project in the world as measured by reserves and resources. We keep calling this a project when in fact it's a district. At KSM, we have 5 separate deposits. Collectively, they give us 12 billion tons of economic resources that are either confined by open pit shapes or block cave shapes. Collectively, these 12 billion tons of economic resources host about 160 million ounces of gold and over 59 billion pounds of copper. As we went through the environmental assessment process, however, we're only now permitted for 2.3 billion tons of tailings facility. So as we've developed mine plans over the years, we were focusing on what is the best 2.3 billion tons to mine first to generate the best economic returns. We got a big help back in 2020 when Pretium finally agreed to sell us the East Mitchell deposit. We acquired East Mitchell from Pretium in 2020 and then integrated that into the KSM mine plan, simplifying the mine plan, getting rid of block caves, and open pit only for the first 33 years. And that updated pre-feasibility study that we completed showed a 33-year mine plan, open pit only from 3 of the 5 deposits, with an average life of mine strip ratio of 1:1, producing on average over the 33 years over 1 million ounces of gold a year and about 180 million pounds of copper. Now, from a financial return perspective, we're looking at a project here that has an all-in cost of production. And when I say all in, I mean all in. The $600 estimate and our base case includes all of the upfront capital, the $6 billion of upfront capital, the $3 billion of sustaining capital, all of the operating costs, all of the closure costs, and all the reclamation costs, net of copper credits. This is a project, when built, is going to be producing gold and copper, not just for the 33 years, but well beyond that. Again, remember that this mine plan here is limited to 2.3 billion tons. What can come next? Well, we actually showed in our updated technical report another 39 years of mine life going after the higher grade copper deposits at Iron Cap and Kerr. And when you combine this mine plan with the PFS mine plan, you're still only dealing with about 4 billion tons of the resource base of the 12 billion tons we have. This is a project that's going to go on for generations. You can make the case that this project is going to go on for more than 100 years, as long as the world still wants copper and gold. I'm pretty sure they're still going to want gold, as gold has been around for 6,000 years or more. KSM is also unique in that it actually has its environmental approvals in hand. If you look at most of these big undeveloped gold and copper projects around the world, they've yet to go through the permitting process. We've done that at KSM. We received our environmental approvals in 2014. They were set to expire in July of 2026. We didn't want that to happen. And fortunately, in British Columbia, there's a concept known as substantially started, that if we can get that designation, our permits are then good for the life of the project. So in 2021, we decided to go after that. We went out and secured $375 million in funding, non-equity funding, through issuing secured notes to teachers, Ontario Teachers Pension Plan, and also Sprout royalties. Those notes convert into production royalties at commercial production. We then took that $375 million and spent it on building roads, building camps, building fish compensation areas, building bridges, and tying into the power grid there that's right next to our project with BC Hydro. By the end of 2023, we had spent about $444 million Canadian on substantially started activities. In January of this year, we went in with a formal application to the regulators, and on July 26, we received formal designation of substantially started. This is a significant de-risking of this asset that definitely paves the way, in our view, to get a deal done with a major mining company to co-develop this asset in a joint venture going forward. Exploration. Our exploration team has found more gold over the past 20 years than any company on the planet. We took advantage of a down market in 2015 and went out and bought 3 new projects, Iskit, 3 Aces, and Snowstorm. We've now finally working on Iskit in a meaningful way. We bought Iskit because we believe it could be another KSM in close proximity to KSM, but more importantly, the same type of mineralization that we see at KSM was known at Iskit. So we went out and bought this asset for common shares. We actually bought a public company, so this asset came in that way. We then started looking around at Iskit. Where can we find some KSM type deposits? And over the past few years, we've done some drilling campaigns out there, leading us to 3 zones. The one that we've announced the results on yesterday was Snip North. We intersected pretty close to surface, wide intercepts of 300 to over 500 meters of continuous mineralization with good gold grades and good copper grades. If you actually compare the grades here that we reported in our news release yesterday, compared to the reserve grades we have at KSM, very, very similar. I need to point out, however, that this is still early days. We still not have found the intrusion that led to this mineralization. We believe that the best is yet to come, and programs as we go forward here will try to vector into the intrusion or the actual porphyry deposits that should host better grades than what we're reporting here already in this early stage drilling. So stay tuned on that. So kidding aside, why do I have 95% of my net worth in Seabridge common shares? Well, first and foremost, I believe the price of gold is going to go substantially higher. Jim and I made a call 25 years ago on the gold price. So far, so good. We still believe the best is yet to come. And if that is the case, our shares should do what they've done in the past, and that's outperform gold and copper in a rising gold and copper price environment. Second, exploration success. We've continued to deliver our shareholders ever-growing ounces of gold per common share on the ground through exploration. We now have 3 earlier stage projects. We're just getting really started on Iskut. That should yield some really big increases in resources going forward. And we still have 3 aces in Snowstorm. But probably the most important aspect of driving value going forward would be the successful completion of a joint venture on KSM. Look, I know I've talked about a joint venture for a number of years. We've gotten close a few times, have not yet delivered that. However, I will tell you now that with the de-risking we've done through Substantially Started, the industry as an industry now looking for new projects, especially on the copper side, and sitting with a project that is so robust from an economic perspective in one of the safest jurisdictions in the world, with permits in hand, I like our chances. A year ago, we brought in RBC Capital Markets to run a formal joint venture process. They're doing the job for us. We have 6 companies at the table now engaged with us on due diligence KSM. And of those 6, I'd say right now there's probably 3 front runners that we are dealing with in a more meaningful way. So stay tuned. This is something we've promised our shareholders for a long time. Our goal in a joint venture is to hang on to a meaningful interest in the project, and I'll define that somewhere between 35 to 49%, but not have to come up with 35 to 49% of the capital. Last slide before we open it to questions. We're a tightly held company and been that way for a long time. I think what I'm most proud about being the CEO of this company now for its entire existence, 25 years now, is our share count. After 25 years, we only have 90 million shares outstanding. And if you look at the asset base we have that we've grown over the years relative to our share count, we've delivered on the concept of providing optionality and leverage to the gold price. And we will continue to do so for our shareholders. Bruce, back to you on the Q&A.
Thanks, Rudi, and thanks, Jim. I think we're going to do what we normally do. Remind everybody on the webinar right now, please type in your questions. If you haven't already done so, please ask. We'll do our very best to screen them so that the ones that sound similar, we don't repeat the questions, and try to get to everything we can. And what I usually do, which I think we're going to do, is rotate between Jim and Rudi. So we'll go sort of a macro question to a Seabridge specific question and back and forth. So let's start with Jim, since he started first. I think that's only fair, right, Jim?
Sure.
One of the questions on the webinar, rather than ask my own first, because you had a couple here, and there's a few parts to this, but I'll start with the first sort of couple. You mentioned when Western investors come back to the table for gold stocks. When do you think that will happen, and what is driving their absence? We'll start there.
Well, we'll start with the absence. First of all, the traditional relationship for gold pricing has been that when real rates go up, the gold price goes down. In fact, given where real rates are right now, which is about 2.5%, gold should probably be trading for about $1,300 historically. So the Western investor looks at that and says, I'd rather own bonds. I'd rather own interest generating assets when interest rates are currently about 4.8% on a treasury bill, down from 5.3. So that's the reason why. And it's a traditional thing. It's been true for a century that when real rates go up, the gold price goes down, or if it's $35 and can't go down, it just becomes less desirable to own it. What's going to happen and it is happening now, is we're going to see rates cut. They have to be cut because interest rates are killing the US Treasury, and they're blowing a hole in the banking system's balance sheet. The US banking system is a $1.3 trillion hole. Why? Because rates went up and the value of the bonds they were holding went down, and those bonds they were holding were driven into them by the Fed and the Treasury, who kept changing the rules to make sure that the offset to declining interest by foreign investors in US Treasuries was to get the banks to buy them. So they've blown up the banks, basically, and you've got about 600 of them, according to the FDIC, hanging by their fingernails. Rates have to come down, and they're going to have to come down substantially. We saw them go down 50 basis points at the last FOMC a couple of weeks ago, way more than they really should have from an economic point of view. But the reason is fiscal. And so what I based my presentation on is the fact that the fiscal arguments for gold are going to outweigh the monetary arguments, and interest rates are going to be less important in terms of real rates than the issue of interest expense to the Treasury and the balance sheet problems of the banks. So those rates are going to come down. They're going to come down hard, regardless of inflation, which is coming back. And that is going to drive huge Western interest in gold. It's not there yet, but it didn't need to be to get us a 2,600 plus gold price.
Thanks, Jim. All right, Rudi, moving over to you. First question, will Canadian companies and particularly Golden Triangle miners benefit from jurisdictional risks faced by miners in such places as Mali and Burkina Faso?
I believe so. I think, one of the guiding principles we formed at Seabridge from day one was try to avoid political risk by focusing only on North America. And it's not just places that you mentioned there. Look what happened down in Panama with, the big copper mine down there, basically expropriated by the government at their whim. Political risk is real. I've built mines in my career that have been expropriated. It tends not to happen in North America, which is why we're focusing there. So I think as companies start to look at what comes next for them, political risk is an important element to that. And I think they will be looking at Canada as a pretty top jurisdiction to be in, including British Columbia.
Why don't we just, I'll ask a little add-on to that question. Rudi, from your experience over the years, what would you define as the countries that you see, just for the investors on the screen here, as the top jurisdictional places that you would potentially look at if from a Seabridge lens or a Rudi Fronk lens?
Well, from a Seabridge lens, it's only North America. We've made that promise to our shareholders, and that's where we focus. From a investor perspective, though, you have to like Canada, you have to like the United States. I'm not a big fan of Mexico. I once was. I think it's changing there quite a bit, becoming more challenging to develop mines there, especially from perhaps taxation. Chile has always been a good jurisdiction. Argentina is being looked at right now, as is Peru, for more copper projects. I find those as historically challenging jurisdictions that I don't think is going to change. Even Chile, that was a great jurisdiction historically, is now becoming more challenging on its own. I think Australia is a good place to be. I would avoid Europe, especially Eastern Europe. But that's kind of where I would concentrate as an investor, Bruce.
Okay. So Jim, one of the ones that I wanted to ask you next was, a lot of the time when you speak about the U.S. and its debt problems, many always ask, is U.S. not the better? Is it not just a better place than some of its large peers in places like Europe and some of the other countries that seem to find themselves in equally as much debt trouble and politically in even more difficult socialist type trouble than you find in the U.S.
Well, it's
Like
true.
a good, bad place, but it's more of a relative thing.
The cleanest dirty shirt, I think, is one of the ways
I think that's the right way to put it.
the phrase that's used. Well, yes, and you can see that by the fact that foreigners own $22.5 trillion more U.S. assets than the U.S. investors own of the rest of the world. So yeah, it's been okay. And in fact, the interest rates have been higher, and that's attracted some money, more private money than central bank money, which has tended to go the other way. So yes, it's true. But if you look at the risks involved now in substantial U.S. investments, first, there's the political risk thou shalt not speak of, which is an election that could go any number of ways and not just two possible ways. So there's that risk. And then, there is the risk of the enormous holdings. For example, the yen carry trade. Some people think the yen carry trade is over, that it's been resolved. And it's true that the yen dollar cross trade has been basically flattened in favor of the dollar, actually. But that's not all there is to it. Japan has $3.6 trillion of money invested around the world in financial assets, not just currencies, but real things. And a chunk of that is in the United States, at least $1.5 trillion worth. And they're raising rates and they're going to take their money home. It's coming. This is not a good thing. There are risks like that are very significant for the U.S. economy and for investors in U.S. So, I see this as a shifting sand, that there is not going to be the kind of demand as there has been in the past for U.S. investments. And even now you can begin to see that there is a flight of capital to emerging markets where the returns are better and where the exposure to the US dollar has been lessened over time, and they are more stable places to invest politically than they were. So, yes, it's been a pretty rocky rest of the world in many cases, but it is getting better in a number of countries, and the US is getting less desirable.
Thanks, Jim. Okay, back to you, Rudi. This is a good question. I like this one. Can you speak to your timeline once you find a partner for KSM? Can you speak to the timeline on how long it would be for KSM to actually reach production, and a little bit about the steps that would be what would take place post a JV type deal that you've been looking for?
Yeah, great question. Obviously, we have that timeline pretty well known based on the work we've done and dialogue we've had with potential partners. So step one of a joint venture will be our partner to come in and complete a bankable feasibility on our pre-feasibility case. That's the one that's permitted, ready to go. We estimate that to complete a bankable feasibility study on our pre-feas case, it's probably 2 years. We then ask our partner, once that's done, they have to make a construction decision to advance the project into production. They have to go out and secure at least 50% of the project's capital in a project facility and continue to sole fund expenditures at the project that would take them from a minority position in completing a bankable feasibility to a majority position. Once construction begins at KSM, it's probably 5 to 6 years of construction. Now understand that we've done some of that construction in advance to substantially started. And we would expect that in a partnership, even during the bankable feasibility study stage, that our partner would see the benefit of continuing some of that work on the ground to shorten the construction period once the formal construction is made. So you're looking at basically 2 years plus 5 years, 7 years to first production.
Thanks, Rudi. Okay, Jim, back to you. I don't know if this one's gonna make you a little more uncomfortable than usual, given that you are spent most of your career on the macro side forecasting gold. But just a question on with Seabridge's substantial leverage to copper, does Jim have a view on all the excitement that's going on both in the world of energy transition, but AI and all of these and all of the corporates talking about how exciting the future for copper is.
Yeah, all you have to do is listen to any 10 minutes of Robert Friedland, and you'll think that copper is the greatest thing ever invented.
Well, there's a running rule that you're not allowed to go to your quote screen or to your broker and buy anything for 48 hours after speaking to Robert Friedland.
I didn't know that rule, but it sounds
Yes.
very sensible. I listened to a presentation of his just a couple of weeks ago. It was pretty extraordinary. I do like his boldness about things. Look, there's no question that we're moving toward a climate when everything is going to be connected to everything, and that requires copper. And although, we've been looking for different ways to do that that don't involve as much copper, so far, nothing works as well. And at anything near its current price, or even double that price, it's not going to be an issue. There will be a demand for copper. There won't be a replacement of any kind of significance. Now, where besides connecting everything to everything are we going to see copper? Well, the electric vehicles don't seem to be such a hot item anymore. I think there's a lot of resistance in the public. The charging is an issue, the battery length is an issue. Now we're starting to worry about the pollution effects of electric vehicles. Maybe they're not so clean as we thought. But on the other hand, AI is generating the need for data centers that looks extraordinary in terms of its copper demands. And it's probably a little more imminent than a switch of our vehicles to electricity. So I think we can see a doubling fairly easily in the copper price by 2030. And part of that is the demand side, but you also have to look at the supply side. A lot of the best mines are slowly going out of production. Chile and Peru have some extraordinary mines, but they are depleting. The grades are getting lower. Production is steadily going down in Chile. So we can see the increase coming, and it's going to be very difficult to find replacement because it takes about 20 years. KSM is not unusual. It takes about 20 years from finding a legitimate copper deposit to getting it to the point where it can produce. So that being the case, I think we can look forward to higher copper prices, even if we don't have to fall entirely for a Friedman explosion. I think it'll be more gentle than he's predicted.
Okay, Rudi, back to you. And I'm going to just give a little bit of context. Your next door neighbor, Tudor Gold, has been opposing your tunnel through their claims for a while here. And one of the questions that just came up here this morning, is there any legal risk that Tudor Gold can still block MTT construction?
We don't think so. I mean, when you look at the authorizations that we hold for our tunnel rights, it includes not only the license of occupation that the government just renewed for us for 20 years versus the initial 10 years they gave us 10 years ago. We also hold a construction permit M245 that allows us construction of the portals, the first 100 meters from each portal, and then also some crosscuts. We've now filed for an amendment of that to cover the entire tunnel length because we completed the engineering and the geotechnical drilling on that route. And by the way, we gave that core on any drilling that was done on Tudor's ground to them so they can do with it what they want. But probably most importantly, our trump card is a mineral reserve. So a mineral reserve is something that we were granted many, many years ago, more than a decade ago, well before Tudor came in. And by the way, all of these authorizations we hold were in place more than a decade ago before Tudor came in. Now, Tudor raised the point and actually filed a formal application with the regulators a couple of years ago, saying that the regulators did not have the authority or the right to issue us all these authorizations. Well, the regulators looked at that. That's what the regulators' job is to do. Clearly, they have the right to do it, and they reported back to Tudor that, no, we have the rights, and they're all valid with Seabridge holes, and now we've just had the license of occupation renewed. I think what we need to point out, though, is that we've been willing to sit down with Tudor for some time now to discuss this. They have been unwilling to sit down with us until recently, and all of a sudden they seem to have switched now that we got the 20-year extension. We have told them very clearly that there is the possibility that we can flex a portion of the tunnel if needed to lessen the impact on a potential mine plan. But the issue is that Tudor does not have a mine plan yet to show that we can look at. They're many years away from that in terms of not just a mine plan, but a mine plan that can get permitted. We're happy to sit down, engage, and talk, but right now we're going full steam ahead. As I mentioned, we've spent over $1 billion on KSM since day one. More recently, about $500 million on construction over the past few years. The regulators are happy with us. They continue to support our applications, and we think we definitely are in a very strong position with regard to our tunnels.
Thanks, Rudi. Okay, back to you, Jim. We're getting close to the hour here, so just probably one more each. But Jim, this one's for you. Jim, you wanted to keep politics out of your discussion, but with an election a month away, could you comment if U.S. economic policies could change significantly with a Republican victory, and essentially any impact you might foresee that on the gold price?
I think the main thing that we're seeing from the potential Trump administration economically is that there would be an imposition of a significant amount of new tariffs on foreign manufactured products in order to drive the reshoring process in the U.S. That is going to take a lot of capital, which the U.S. currently does not have, and it's going to drive higher prices. It's going to be inflationary. There's no way around it. We can't see, and neither party is promising any budget cuts or any attempt to return to a balanced budget. I think that's actually out of the question now because interest rates have driven the deficit so high anyway. So I think that's what we're looking at. Potentially is a lack of capital, which is going to drive the cost of capital higher, and inflation, because tariffs will support more reshoring, but expensively.
Thanks, Jim. I'll leave the last one for you, Rudi. It's a little bit of a follow-on. This is just related to Tudor. Does it make any sense to combine Tudor's claims with KSM?
If we're only that easy, Bruce, we would have done that years ago.
Understood.
We continuously look at ways to improve KSM. A great example of that was the acquisition of East Mitchell from Pretium a few years ago. And we bought that because we saw the clear opportunity that would improve the project's economics, reduce the need for block caving, and make the mine more executable. We looked at Tudor, we looked at their mineralization. It just doesn't work. I mean, to be perfectly honest, anything that they've identified so far would not displace anything in our mine plans, not just for the first 33 years, but beyond that. The biggest issue that they face there is metallurgy. The test work that they've done, if you look at most of their material that they quantify as resources there, it's refractory. They're going to have to design some sort of oxidation process within their flow sheet to recover the gold in a meaningful way. And if you look at companies or projects that have to go through an oxidation process, not only do you have very high operating costs, but also very high power consumption. We're blessed at KSM that if you look at our metallurgical performance there, our metallurgical estimate in terms of recoveries and processing is only $6 per ton that goes to the mill. To go through an oxygen plant, you're probably looking at, I'll give you an example, Pueblo Viejo probably has a similar oxygen plant that Tudor may have to look at. They're looking at upwards of $50 a ton. So you look at the cost of that. The other issue that they have is how are they going to mine their deposits? They initially went out with their initial mineral resource estimate looking at a big open pit. That's how they constrain their resources. But if you look at the strip ratio of that open pit, it was pushing 10 to 1. At $250 per ton mining costs, just to mine the waste to get 1 ton of ore, they're incurring $25 of operating costs just to get 1 ton of ore. At KSM, we have a strip ratio of 1 to 1. Okay, so we incur $250 of operating costs per ton of ore mined. Big difference there. And then on top of that, if you looked at the open pits that they did design, they had to mine a glacier. We don't have to touch any ice at KSM, no mining of glaciers or ice. I believe that in the current environment in British Columbia, trying to permit mining glaciers may not be an easy task. So what they do after that kind of didn't resonate for them, they couldn't complete a PEA on that, they then moved to block cave mining. Okay, block cave mining is a great way to mine. However, you have to take into account that the upfront capital costs to develop a block cave are huge, whereas open pits, they're not. Tudor's now come back again looking at, okay, they have these supercells that they're calling. I'm not a geologist. I didn't know what a supercell was, so I asked my geologists, and they never heard of it. I think within these porphyry environments, you get these high-grade pods there. I remember back early days at KSM, we were drilling sulfurettes. We had an intercept there of 2 meters of 1,551 grams per ton. Exciting, right? Well, we couldn't tie them together to actually make it a mining block out of it, so we didn't. They're looking at perhaps connecting some of these higher grade intercepts that they have. Great. Let's see how they develop that in a mine plan. It's going to be a lot smaller than what they were looking at previously in terms of the big block caves and the open pits. Look, we will continue to follow their progress. Clearly, they're a neighbor of ours. We want to engage with them. But at this point in time, back to your question, there's just nothing there that they have today in terms of mineralization that works for us at KSM. So we're not going to go after it.